Welcome everyone to Office Hours with TradersPost, September 6th, 2024. We did it. We survived the summer. It's over. We can get back to what really matters, the best season of the year, fall. Are you guys with me?
We're not there yet. I'm not ready
Yay.
for summer to end, and I don't think it officially ends until September 22nd. So let's talk again on Office Hours in 2 weeks from now.
I already have Halloween decorations and Christmas decorations prepared in my hallway put up. I'm done with summer. God, I hate it.
So my wife is making chicken noodle soup, and she made a comment that she wants to start watching Halloween movies already
That's right.
because a cold front came through last night, so it was like freezing this morning.
You need pumpkin spice. You need the whole thing.
Yeah, you and my wife would get along famously. You're speaking like you're her. It's uncanny.
One thing's
She's
for
like
sure.
pumpkin spice lattes from Starbucks. We got leaves coming up, Halloween.
Well, dead of winter, when I'm cuddling with my wife at night, she's never like, "Oh, I hate this." That never happens. But in summer, forget it. I can't touch her.
Yeah, no. We don't even live in the same room in the summer. No, I'm kidding.
All right. Oh, 1 second. All right. So I wanted to let's start off with just a couple of updates. One, happy to mention, we did talk about this last week, but sessions alerts, which is just a script that we created and published just to show how it's possible to send an alert to anywhere but the TradersPost in order to close trades before the end of a session. So like right before the candle will need to close. It takes advantage of the idea. There's a new modification to the time attribute in the time method in PineScript, where you can check the time on a future candle. So we didn't have that capability a few months ago, but now we do. So that in that script sessions alert, you'll be able to see that there. You'll also be able to the way I like to do for alerts in PineScript is that I like to count how many lower time frame bars have passed for my higher time frame one. Because I don't know if you guys are like me, but once I've chosen my higher time frame and my lower time frame to deal with, I don't think about time anymore. So I don't want to be setting specifically at 3:57. I want to close a trade. I want to be like, I'm on the 5-minute time frame. When there's one more candle left before the thing closes, send my alerts to close it. So that's how I like to set it up. So
Got it. So if I'm on the hour time frame, does it close like an hour before the market closed then?
No, so if you're on the hour time frame, you would then choose. But let's say you're trading, you're trading the 15-minute. Well, then you can say on the third 15-minute bar, send a signal to close the trade.
Interesting.
And if you're on a daily, sorry, go ahead.
Does that require? Does that require the bar magnification feature in order to access that lower time frame data?
No. So as long as your subscription allows you to have access to that time frame, it's there.
Okay.
It's really just a counting mechanism. I used to have it before they had the modification to the time method, because there was no when you choose the hour, minute, or second using the series variable, it only really gets updated when there's a tick, when there's a trade that happens during that candle. And so I like this other method. But even with that new change, I just don't think about trading in terms of time. I look at the candle, and once I'm trading that chart, I don't even know what time frame I'm on anymore. I'm just dealing with whatever candles are there.
Yeah, except for when we know we want to close everything up, in the last couple minutes of the session. So
you can still set that. So the script also allows you to set it, just like ignore the granular control for the bars and just, hey, this is my trading session. Make sure that whatever chart I'm on, the bar before, close it. So if it's an hour, it'll wait. You'll basically send a signal an hour before the day closes. If you're trading
that's what I thought you would say. So if I'm trading an hour chart though, and I want it to close at 3:57 p.m., is that possible with your script?
You want to then use the granular one. You want to just set the alert specifically.
Set the alert on the minute chart, but then trade the hour chart.
Exactly.
Okay. Yeah. Got it.
So it's documented, it's published. You can find it on the traderspost.io/blog. There's a new post there today. Click on that, you'll get it. As always, we like to publish things privately just to kick the tires, see what people think about any changes, any feature ads, anything like that. If we have time, we put it in, and then once it's all like polished, maybe 6 months from now, I'll go ahead and make it public.
Yeah, assuming TradingView doesn't ban us from publishing content. That's the struggle we keep having. They're like, no, this is duplicate content of something else. We're like, no, it's not. This is the TradersPost version.
Well, the reason I did this one is that there's not another script like it. There was one that was done like 2 years ago. I was like, okay, they can't really complain about this one. All right. Next up, I wanted to mention for the Schwab API integration. John, I know there's been a albatross around your neck here. Could you give us a little bit of an update as to like what's going on with that?
Yeah, unfortunately, we have not been able to make progress with Schwab and getting access to their commercial trading API. They denied our request, and they've approved other people that are similar to us, and they won't give us any indication as to why. So unfortunately, right now, it doesn't look like we're going to be able to support Schwab, but I'm going to, try to be naggy, and every couple of weeks, shoot them an email, and maybe I'll get a response, or maybe I can get them to reevaluate us. But right now, it is not looking good, unfortunately.
That said, we need you, all of you listening, to reach out to Schwab if you really want them and let them know it doesn't make any sense that you're not supporting TradersPost. Please support TradersPost so that I can integrate with Schwab. And that would be helpful. Obviously, if we can crowdsource the problem, we can get a little bit further.
I'll get some AI bots on the issue.
Yeah. Part of me wondered, like we've been sending so many people to Schwab. I wonder if they're like, oh, it's those TradersPost guys again.
I guess we'll just have to give in now. They've got an army of people reaching out to us.
All right. Well, before we get into the questions for this week, if you guys have noticed, we're at a new time. We're trying a new time here for office hours and after hours. We've been experimenting with all the different formats and what might work well for everyone. And the feedback we've been getting internally and from people watching is that, doing a show at 3:30 and then leading into after hours after the bell close might be more suitable, might be more readily accessible to everyone. So we'll see what you guys think. If you guys like it, post in the chat, let us know what you think, if we should keep this time. But I pretty much, I'm liking this so far. Like, I like that to have the day of the trading like underneath my belt to get a sense of what's going on, get some of the headlines. So I think you guys would feel the same way. This feels pretty good.
I think the one rule we need to follow here, and it looks like this comment is from Blockeroni. He's at work at the moment, so we can't tell on him, can't tell his employer that he's actually watching us while at work. But good to hear that we're at a time in which people still feel like they can sneak in a minute or two watching the TradersPost show.
That's right. Excellent. All right. So first up, this is a question we received this week. Do you ever recommend prop firms for either equities or crypto? So we don't specifically recommend any prop firms. One, because that's, you correct me if I'm wrong, but that's never been like the nature of TradersPost to like target prop firm accounts. But what do you think about this, John? Is this something that we should be paying more attention to?
We don't support any equities or crypto brokers that are prop firms. The only ones that we're aware of now is Tradeovate, like what is it?
Ninja
Apex.
Trader.
Mm-hmm.
Yeah,
Top
Ninja
Step.
Trader, Top Step. They're all built on top of Tradeovate. So if it's a prop firm that is built on top of Tradeovate, then we'll support it. But outside of futures, there are no brokers that we support currently. But if there's ones that you're interested in, definitely let us know. We'll get it added to the list so that we can evaluate it and hopefully get it on the roadmap. And usually what we do is we add it to the website so that people can submit it, add themselves to the wait list. And that kind of gives us our stack ranking, so we know, which brokers and exchanges to integrate with next based off of which ones people are requesting the most.
I don't have this question here, but it actually came up a few times, and that's people like me, the Canadians, where the only platform that we have is IBKR. I mean, non-crypto, IBKR, and people have been asking for Quest Trade. I've seen that a couple of times. I don't know if they have an API we can connect to, but also, I guess this rolls into the next thing, Webull, right? So the question here is, how do I get my API credentials from Webull? I don't see the option in my account.
Yeah, so I did the integration with Webull, and it took me about a month of emailing Webull support to get them to enable the API management section within the Webull profile or account settings. And I did the integration work, and I thought that other people would just have to request the access, but it turns out that everyone that's requesting Webull API access, they're declining it. So we have the integration done, but I guess Webull isn't ready to grant people access yet. But it's kind of similar to Schwab. I would keep asking them, keep persistence, and we'll do the same on our side. And hopefully we'll get unblocked in the future, and people will start to be able to use Webull with TradersPost.
So for us Canadians, is it IBKR we should really be focused
Pretty
on?
much,
Or?
yeah. I think Alpaca might support Canada. I mean, I know that they've been expanding their country list, but that's one I would check is Alpaca. I don't think any of the others will support Canada, though.
I see. Well, be a crypto trader, move to the United States, or while people are making petitions to different brokers, maybe they'll make petitions to us to become a broker ourselves, the best broker in the world that never refuses anyone and has an API team that could support 1 million people.
That sounds like an endeavor.
That takes some work.
Whenever Mike doesn't just jump on an idea that I give, I know it's dead in the water. It's never going anywhere.
Take us 10 years to accomplish that goal.
That's right. All right. So, something more specific to using TradersPost is a question here. Why is my Robinhood trade failing when I'm using fractional share quantities?
I didn't see the specific context around this or the order, but the most common cause is you're using limit orders, and Robinhood doesn't allow you to use limit orders for fractional quantities. You have to use market orders. So if you're not trading something that's like really like tiny in cost per share, there's really kind of no point in using the fractional quantities. If you're buying $400 SPY shares, like a half a share, doesn't really make that big of a difference. But if you do want to use it, you just have to make sure you're using market orders, and then the orders will go through successfully.
Yeah, the one case that I can see for fractional shares in general that sort of opens the door to managing a portfolio better is if I only have, let's say, $5,000 or $6,000, but I want an equal weighted portfolio or a specific weighted portfolio of, let's say, 12 or 13 different stocks. So while the per share cost might be in the hundreds of dollars, I still need it to represent a particular weighting. So that comes up quite a bit. That allows you to actually scale the portfolio appropriately.
Yeah.
Okay, that makes a lot more sense. I was wondering what the use case was, because I remember when IBKR popped up fractional shares on me like a year or two ago. I was like, why do you want to timeshare me into these shares? It seems pretty sus.
Timeshare you in.
But this makes a lot of sense.
And there are some cases where brokers, they don't support trading fractional shares, like you can't buy. But when you get dividends and things like that, you'll get partial shares, and then they'll allow you to sell them, but you can't buy them partial like you can on Robinhood.
Right.
All right. There was this question that, or this conversation that was happening on Discord this week where it had to do with multiple orders being sent into TradersPost, the whole race condition issue that we've talked about a few times. But this was sort of suggested where would TradersPost consider adding an order queuing feature that ensures that one order gets completed and then the next one follows and the next one follows. Is that something you've considered at all?
We have thought about it. We want to try to add some new capabilities to the webhook payload. So instead of having just one trade within the payload, you could specify multiple, and then they would be executed serially instead of in parallel.
I see. So is that something that is like likely to come to the TradersPost platform? Is it like more trouble than it's worth?
That's a good question. I don't really have an answer. I know that we've talked about it and it's been requested. What would you say, Mike? Maybe like a dozen times over the last year or so.
I think it's increasingly becoming a bigger and bigger priority. Yeah. I mean, it's not only is trade serial execution something that comes up quite a bit, but the ability to execute multiple orders together is also pretty common. So I think the feature's high enough demand to where we should take a look at it pretty quickly here.
Yeah.
Interesting. Cool. Someone was asking if they have a premium package or any package with a specific limitation to it. Here they only had the ability to have 10 paper brokers, and they want to know if they can add more. Is that something that we offer where someone can do that?
Yeah, if you email support@traderspost.io, we can increase the limits. But we want to understand the use case, and what you're trying to accomplish and what you're doing, so that we understand better. But I think long term, we really want to move to more of like an a la carte pricing model, to where you can just buy as many broker connections as you want, instead of like having these rigid plans with the limits. But that would hopefully be something we would do in the future, and that would be able to allow you to, if you want to trade crypto, you would just buy access to crypto. If you want to trade 5 live broker accounts, you can just add as many as you want, and then you would get charged for them at the end of each month.
Yep.
Yeah, I can imagine that would appeal to quite a bit of people. But I imagine there would be some sort of minimum to that, because if someone wants just one broker or just one paper account even, would that make sense for us to do? But I guess
the starter plan is basically that. It's just one asset class, and one connected broker. So maybe it would be, I don't know, we still have to think about how we would actually implement it, but maybe it would be like there are still plans and you get maybe a discount on the plan compared to if you were to buy all the things in the plan individually. But if you don't want to upgrade to the premium plan, like you can just buy one extra of an individual thing, and it would be like you have your cost of the plan, but then you have other items that you can buy one at a time to just add on top of your plan, if that makes sense.
sure. When I think of nightmare subscription like services or anything like that, I think about Netflix and 150 people on one Netflix account, and I sometimes have these hot flashes of imagining somebody with a TradersPost account, and they've connected it to 50 different brokers, and they have all kinds of different subscriptions, and like 5 different people are trading through it.
Yeah.
Which is not good. But
Yeah, it's a tricky balance. Like, we want it to be simple, and in some ways the a la carte makes it a little bit more complicated, and I would almost, in a perfect world, I would love it to be just like 1 or 2 prices with no limits. But the reality is, like, there have to be some kind of limits, because people will do ridiculous things and, basically abuse the system in ways that could affect like the environment as a whole. So like we have to have some kind of sane limits so that it protects the health of the system.
Without having to change it and go roll back to a different, you can't
Yeah.
change it often. So totally understand that. Excellent. All right. Next up, this is the first time I've ever seen this, and you'll let me know if this actually makes sense. I'm not sure what situation this would be useful in. But this person was asking, Tim Fain was asking on Discord, can I use TradersPost to stream live data from Tradeovate into an external app like Python for analysis? So you're already connecting the paper broker, or you're already connecting the broker to the TradersPost is a way of accessing that information then directly. Does this make sense to you guys as far as a use case?
I think that this will fall in line with what we want to provide as our generic API, or our sort of single flow API that connects to all of your brokers. So effectively, you'll be able to get all your order history, all the trade P&L from TradersPost after these things take place. So in theory, you can send trades through TradersPost and then pull that data back down through the API into a Python environment to do additional analysis on that after the fact. And that's certainly, a path that we're looking at in the future. John, did you have thoughts?
Yeah, well, based on his question, I wasn't sure if he's referring to like live market data or position and order data, but either
I think
way,
position and order data is what I'm reading. Yeah.
Got it. Okay. So in any case, I think that if we did build an API, it would support both.
A real-time WebSocket API as well as HTTP.
Yeah. So you'd be able to like proxy the live data from your broker through TradersPost. But then in the future, like we have our own market data providers that are independent of individual customers' broker connections. And we could provide that market data to our customers as well. That would basically allow you to build applications on top of TradersPost or build, private systems just for yourself. And you would just have to integrate with TradersPost once, and we take care of all like hiding via an abstraction, all the complexities of the individual brokers. And you just have to worry about integrating with TradersPost, and you get one nice, clean API integration, no matter which broker you're connecting to through TradersPost.
This feels like as you're talking about it, feels like the second level evolution of a Pokemon. Like, okay, now this is a beast of a different make. Because I remember when you were last year when I heard you speak about the inception of TradersPost, you described this thing that you had built for yourself, and then other people were like, "Hey, can I use it? Can I use it? Can I use it?" Did you ever imagine that it could get to a point where people are talking about now, "Hey, I want to use your system as a layer between my brokers so that I can go back and forth and build applications on top of it"?
Yeah, I mean, really, since day one, I've always wanted to build an API. It's just you got to kind of pick and choose what you want to build, and each thing you build is kind of a stepping stone to the next thing. But there's a lot of things that go into building a scalable API from an infrastructure perspective and from a software perspective. So it's definitely something we want to do, and I think that'll unlock a lot of revenue opportunities for TradersPost, because then we can sell TradersPost to businesses, and businesses can then build their software on top of TradersPost. And like if Benzinga or a company like Benzinga wanted to build a trading application, they wouldn't have to integrate with all the individual brokers. They just integrate with TradersPost once, and they get the benefit of all the integration work we've done. But it's not something that's kind of made it to the top of our priority list yet.
If TradersPost gets big enough, can we then bully brokers into having features that we actually want?
I mean, the leverage does start to flip at some point. I think we're still the small guy, but we have made progress with some of our brokers where we are big enough that they pay us more attention. Alpaca, TradeStation, Tradier, they pay attention to us. And, when we email them and ask them questions, they respond and they engage with us. So yeah, I think slowly the leverage will start to shift, and we'll be able to kind of drive things and ask for things on behalf of our customers, and things that we identify that would be useful for our application. Maybe we can get them to add it to their API. But yeah, I think it's definitely possible in the future.
So we don't need like a scorched earth Elon Musk type policy where we publicly lambast companies for not having features that we want.
I mean, maybe not like directly, but that's on that topic. Like we've thought about, and I think it's something we will build. Like we have a lot of great data on all these brokers, as far as their reliability and like the average response time. And I'd love to surface that to the customer so that people can make an informed decision when they're choosing a broker, like which ones are most reliable, which ones have the lowest error rates, but then also collecting customer reviews. TradingView does that. If you go to their trading panel, you can see star ratings for all their broker integrations. So I think Peter says the TradersPost files. But I think that would be really cool and useful. People always ask us for recommendations, and it's tough for us to do that. Like we try to avoid giving recommendations, like individual one-on-one recommendations. But if we were to publish all of this data centrally to everybody, then people can browse our list of brokers and just see stack rank, like which ones are most liked by TradersPost customers and which ones have the best reliability, and that'll help guide people in making their decision.
Nice. Hey, that would be pretty cool. All right, so we have more power than just executing orders. We can change the course of financial history. I like that. All right, a couple of last questions here. The first one is from Squirtle on Discord. Is it valid to send multiple take profit orders attached to a single entry order?
It is not right now. It's actually kind of a limitation of most of the brokers. They actually don't allow, like they have a concept of bracket orders, and one cancels other and one triggers other. A bracket order is basically an entry order with an OCO attached to it. And you have your entry order, and then the OCO is a take profit and a stop loss. And the OCO, one cancels other order, remains like in an inactive state until that entry order fills. And then one of the OC orders, both of those OC orders become active. And if one of those fills or gets canceled, if one of those gets filled, it cancels the other. So we basically are like our webhook, and our payload is just a layer on top of that broker. So it's not possible, but what you can do is just send your entry order separately, like you would normally without a take profit or stop loss. And then you can send multiple subsequent take profit orders whenever whenever your logic triggers in your strategy. So if you entered for 10 shares, or like say you had 2 entry orders for 5 shares each, and you have a total of 10, you could send 5 separate take profit orders with a quantity of 2 to kind of layer out of that position in a similar way to how you layered in.
One alternative to consider there is that you can layer in and layer out at the same time. So in theory, you could create 5 entry orders, which all have brackets attached to them at 2 shares each or 2 contracts each. And that would mean that if I entered at 100, I have a take profit at 105 and 98. Then I can enter at 99 and a take profit at 104 and 97, and so on and so forth down the list, which means that if I entered all 5 of those positions, they all have different take profit and stop loss zones, but they're all going to trigger independently of each other. Yeah. So you can, as long as you've married the take profit and stop loss to each entry, then in theory, you can scale in and scale out in the same way.
Right. And you would just have to disable the exits from your strategy. And probably disable the order canceling in TradersPost so that we don't ever cancel any of those other orders. And you'd basically be using TradersPost to send the entries with your take profit and stop loss, but
not manage the exit.
You'd be 100% relying on the broker to execute those exits.
Right. Yep.
Which is ideal. Most people want that.
Yeah, that's ideal. Then you're actually taking the trade the way it was designed.
Right.
Right.
And then the only other thing to be aware of is like if you do send exit orders, some people will do both, where like they want the take profit and stop loss to be in the broker ahead of time, but then they also have more dynamic stop loss logic. And there is a little bit of a risk there where like if the broker or the exchange executes your stop loss at literally the exact same time your strategy is sending an exit signal, those two signals can conflict with each other. And you can end up in a scenario where the broker exits the long position, and then you send an exit for the long position at the same time. And TradersPost sees that long position is still open right before the broker exits it. And then we send a sell order thinking we're selling the long, and it goes short.
Right.
So
just another great reason to paper trade this stuff for a couple of weeks to confirm that all your orders go through the way you expect.
Yeah. Yeah.
It's almost always it's a law of the universe that once I deliver a strategy script to a client, that will be the scenario that they get the moment they try to test it out.
First time.
And I would also just add, like, it's kind of a general rule. I mean, in life and engineering, like the less moving pieces, the better. And like if you feel like you're running up against these weird edge cases, it might be because you're overcomplicating things, and in a lot of cases, simple is better. And that would be my general. That's how I approach things in trading and in programming and engineering, is just try to keep things simple.
Mm-hmm.
Fair enough. I've been annoyed with myself because I'm doing this prop firm challenge that I've been for the last couple of weeks, and if I trade it myself manually during the day, I'll lose money. And then, but because I can't bear the thought of going to sleep without having a trade on, I'll set up my trades properly, and then I wake up, and then that has made all the money that I lost. And then that day I'll lose money, and then at night I'll gain the money. I'm like, oh my god! But it's in the nighttime trades. It's all very simple. I'm not overcomplicated in it. I know what my rules are. I've set up the different orders that I execute. I know what my loss is. I know what my win is. So yeah, I guess simple is better. But I have not learned that lesson. I will not learn that lesson. I refuse to do it. It feels too good to lose. Sorry. All right. Last question is an options question. Someone was asking if they're able to set a sell when the option reaches a certain dollar amount in profit or percentage in profit.
Not directly. Brokers don't operate off of P&L. Like their stop losses and take profits don't operate directly off of P&L. But if you buy something at $100 and you buy 10 contracts and the price goes down to 90 and you get stopped out, you'd lose $100. So you have to do a little bit of math, and it's the combination of your how many shares you buy and where your stop loss is, and that kind of determines what's your max loss for that trade. And then similarly on the take profit, if your stop loss is 1x and your take profit is 2x, so you always have like a good ratio there. But there is a feature within TradersPost called it's called the risk per trade position size. And if you send the stop loss with the trade, we can dynamically calculate how many shares to buy. And if you say you only want to lose $100, then we'll only buy the number of shares that would cap your max loss at $100.
I understand, but that only works with shares, not with.
Yes. It would work with options, but you would have to send the price of the contract in the stop loss, so that, if your limit price for the entry is $10 and your stop loss is $9 and you only want to lose $10, then we would be able to buy 10 contracts.
Okay. Understood. All right. Well, that's it for the questions we have for this week. John, Mike, is there anything else you wanted to touch on with what's been going on behind the scenes with TradersPost? I know you touched on a little bit about the potential for different pricing. Mike seemed sort of hot or cold on developing a new broker, a 10-year plan.
Becoming a broker dealer? Yeah, no, I'm not hot or cold. I'm definitely cold.
I feel like becoming a broker would probably require some outside money to be invested in TradersPost. There's just so much involved with it, from the regulatory side, lawyers.
It's a process.
It's an engineering problem as well, but there's a lot involved with it.
Well, with Cursor AI version 2, when it comes out, anybody's going to be able to build their own broker. Excellent. All right. Well, it's been fun as always. We will be rolling right in a couple of seconds here into after hours, where Mike and I will be going over some of the market events this week. John, I'll let you go. I know you're going to be very busy.
All right. Thanks
perfect.
for having
So
me.
we'll see you next week.
All right. See
you later,
guys.
Wage.
Thanks.
All right. So here we cue the after hours music. Boo-doo. Pachoo, 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 boom, boom.
No, we need the
Explosions.
market bell. We got ding, 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 ding.
I got no
Old
bell
school
yet.
market bell. I need a gavel of some kind, like the NYSE gavel. We need something to intro this now. Now that we're officially doing the show after hours, after the bell, ideally at the bell, that would be cool. But even a few minutes after, there's already some activity taking place. A couple companies are moving by a couple of basis points after the bell, but for the most part, it looks like markets are quiet. And now we can kind of review how things went this week. It's been an interesting one.
Excellent. Well, some of the major headlines we have for this week has to do with jobs reports and unemployment. We have inflation volatility come into the mix. And we have crypto gaining acceptance all around the world. So let's jump right into it.
Let's do
Mike, the jobs report and employment numbers. This has been, I mean, it's all about revisions this year, right? Or the last 2 years, but really over the last year, the revisions to the numbers that are coming out are bananas. They completely changed the stories that we're seeing. So let's just take a look at a couple of the headlines, if you don't mind. 1 second here. So we have stock market. I'm getting used to this, Mike. I'm getting used to this. Stock market today, stocks slide after surprise August jobs report. And the jobs report surprise adds to case for bigger Fed interest rate cuts. What's your take on these things?
Yeah, I think the second one is really interesting because there's been this debate for a few weeks now as to whether or not the Fed is going to cut by 25 basis points or 50 basis points in the next upcoming FOMC meeting on the 18th of September. After this report, though, today, the futures market is really printing a much higher probability of just a 25 basis point cut, and largely because the concern around how much of an impact the interest rates have had on the economy aren't as big as we once thought. Unemployment rate actually came down by 10 basis points, which was forecasted. Non-farm payrolls are a little weak, but really not too far off from a forecast of 160,000. They came in at 142,000. And so it looks like the futures market is saying, great, we don't need to cut aggressively. We think there's a 71% chance that we cut by 25 basis points in a couple weeks from now. So I think that's sort of good news, but it seems like the markets have reacted pretty negatively to the report, and we saw a pretty strong pullback today. Almost 3% on the NASDAQ, about 1.5 on the ES. And obviously crypto has followed suit from a correlation perspective and started to pull back as well. Very interesting day in crypto. My take on this, though, is the revisions are an interesting one. It feels like the demand on the labor departments to print accurate data quicker is higher than ever because we've just never really paid this close attention to these types of economic indicators. And I guess there's some speculation out there that the data might be manipulated, stuff like that. But I'm not so convinced of that. There's a lot of companies that are polled for this data, and it's a sampling process. The revisions largely come from a data collection process that is comprehensive and layered, and is shared between multiple agencies. So I feel for the data collection agents, or I'm not sure what their exact title is, but for the people involved in actually collecting and analyzing this data, man, their role almost seems as important as the things the Fed chairman says in the FOMC meetings, right? Like the pressure is on to print accurate data, and when revisions come in, people are pretty upset about it. So that said, I think the news here might be a little overreactive. The economic indicators that we're reading here are pretty positive. The recession fears, I don't think, are as big as they once were. We might actually still be heading towards the possibility of a soft landing. I'm thinking back to like June of 2022 when we printed 2 negative quarters in a row, and the news was all hyped about the possibility of a recession. Fast forward a year, that never happened. That never came. In fact, the economy seemed to bounce back even further, printing quarter over quarter GDP growth up until this last quarter, showing a 3% increase. So it just seems like we're not getting the economic indicators that are telling us a recession is impending or on the horizon, other than sort of our sensitivity to variances in these types of jobs reports. And that's where I'm wondering if we're reacting a little too heavily to these things.
Well, I find it fascinating, one, that you would say that you don't think that the data is being manipulated.
Okay.
I mean, not that we would know for sure or not, but I'm not going to put it past any U.S. government, looking at it from the outside, to manipulate the data to be able to gain in the short term. Like there's always been revisions to these numbers uh, constantly, but not to this degree. The swings are so large that sometimes it'll go from net positive to net negative, and the revisions are almost always like 95% of the time in one direction. It's never like the other way, and you're like, okay, well, why haven't you fixed this? Your way of calculating this, it's been a year and a half this has been going on.
Mm-hmm.
And they just so happen to always favor the current administration, so that they could hang their hat on something. Oh, we have new jobs that are added. Oh, excuse me, revised 3 months later, and now it's negative. And so you're seeing the when I see those changes, I always like to look at the betting markets, and because I want to see, are the charts sort of reflected in the same way on Polymarket, on Predicted, and all that sort of thing, to see for the presidential election. And the worse the news is for the administration, it seems like the more the revisions or the numbers that come up are made to seem better than they are, but we don't know for sure. What we do know, though, is that we've had more leaks of this information, of the reports. Have you seen people talking about this?
Not the leaks, no.
Yeah, where the reports are being leaked out like an hour or so beforehand to certain players within the markets, and then the markets move an hour before the or up to an hour before the numbers come out, and then there's a big sell the news sort of event. So like, I think even today crypto shot up. Shot up in the context of intraday, and then came back down the other end. But this is happening more and more before the numbers actually come out, and so there's this sort of like conspiracy underneath. It's like, hey, are they leaking the numbers? Is there a leak within the within these bureaus that are allowing larger players to be able to position against retail investors? That to be is pretty interesting, but who knows? One thing's for sure: whatever number we get for the reports, don't pay attention to it until 3 months from now.
That's
Wait
right.
for the revised number.
Yeah, I think if I could share just a research paper from the St. Louis Fed, and I think that this is really what informs my opinion around the idea that we have to be a little careful as to how we respond to preliminary data. This is a research paper that really just kind of covers this idea of whether or not employment data is actually biased from the individual agencies. And I think it's important, especially around non-farm payroll data, to recognize how much of this data is preliminary, and also start to measure the magnitude of the revisions over time. So like this chart right here actually starts to plot out how frequently we see magnitudinous changes in the employment data as we revise it. And I guess the point is, like, the median revision magnitude is one of those things that occurs frequently enough to where we should expect it. So I think our sensitivity occurred because for a period of time there, the revisions weren't as strong as they were recently. But I guess my question is, have they been this magnitudinous in the past? And can we observe that over time? And again, I think maybe a part of it is really understanding the collection of data and how that process works to make it more accurate over time, because it's all really kind of based on survey data that the BLS collects. And over time, as new data comes in, because we're waiting for responses, that data can change, right? Especially if your sample includes information that wasn't previously collected and now suddenly is. it might change the data to a large degree, and that's simply a sampling bias problem, right? Where initially our sample didn't reflect some of the pockets of information that are crucial, and now suddenly they do. So I guess I'm taking this more from like a statistical standpoint and less of a concern about government manipulation, but happy to be wrong. Like I'm obviously the type of person that's not quick to jump into conspiracies, but how it would be manipulated and the motivations behind it is what I'm really curious about.
Right. Well, the thing that bothers me the most about it is the and I think Daniel DiMartino Booth, a former Fed insider, author of the book Fed Up, has sort of been like suggesting this, implying this, is that the Federal Reserve, the central banks, do use this information in order to help make their decisions about what to do with interest rates and liquidity and all that, and they're not mentioning these revisions as being problematic. Like, they're not saying anything about it, and it bothers me that they're saying, "Oh no, the markets are good, labor markets are good," and you go, but no one's. They're never saying, "But we know we have to wait 3 months in order to see if the revisions are fine." Which
I
means
think that latter of what you just said there is the critical part. If they're already aware that revisions will come in and they're less sensitive to preliminary data, then they're driven by the more accurate revisional data rather than the early preliminary data, right?
are they though? Because when Jerome Powell's having this conference or when he's speaking at Jackson Hole or whatever, they're never mentioning that, hey, the data is like wildly off, and we know we can't. We know that you got this report last month, but we really got to wait. They're never saying that. They're saying the labor market's doing great, whereas all indications are showing that we're not in recessionary territory, but we are contracting.
Yeah.
I mean, that's essentially the definition of a recession, even if it's a shallow one or the beginnings of one.
Sure. Fair enough. Peter says the report is generated by ChatGPT. Here's the twist. Okay, that makes a ton of sense. It's a good question. I don't know if they truly are as sensitive to preliminary data or not, or driven by that data. I think you make a fair point. That said, I know that the Fed chair governors are governors. I'm not sure I'm using the correct term there, but are not stupid people, and they certainly are aware of how these biases can exist within the data and how to respond appropriately. But I think the bigger question still is around how this data is managed and how bias is accounted for in the collection of that data and how accuracy is monitored. So I think it's important we at least like try to observe what the collection process looks like, how they verify the data, how accurate it is, and how the revisions have changed over time. Is this kind of like a recency effect, right? Where we're observing this big magnitude of revisions of data and automatically assuming that something's wrong with the process without observing the whole history of how this works. Like, maybe that's my point.
Absolutely. And in fact, I mean, when it comes down to it, we want to make money in the markets. And it does not benefit me at all to think that they're stupid. If they are, I mean, we're in trouble. So I might as well think that they know what they're doing, and that if they're relying on data that they know is going to change later on, or it's inaccurate or whatever, I assume they're factoring that into their decision. But I also am assuming that they want us to believe that this data is accurate, like when it first comes out. The whole policy of the Federal Reserve is an expectations policy. They need to manipulate people's behavior based on what they're saying, and they need us to behave in a certain way. And so I'm fine with that, because then they're like, okay, if the shepherd is trying to herd us in that direction, and that direction is chart up and to the right, well, I'm not going to start yelling against them. What am I, Peter Schiff? I don't want everything to collapse. I wanted to continue going up and to the right, so I'm not looking to rock the boat, make the money, and just be ready to pull back on the brakes when the inevitable revisions come. The last thing I wanted to say on this, though, and I'd love to get your quick take on it, even though I'm just springing on this you right now, and that's the idea of the moves that we've seen recently in the markets, in the tech sector and in crypto, has been, or especially in the tech sector, have been significant when you're looking at how people are talking about online. We've had a decline, blah blah blah. It's not 50% down in the markets or anything like that, but it is noteworthy.
Mhm.
And I just wanted to point out something that we've been touching on previous after hours, which is this idea of gamma within the markets. So the options markets really are, I mean, not just my point of view, but for a number of economists, the options markets really are what drive a lot of the moves that we see in index names and mega cap stocks.
Mhm.
And so we have this the situation where what might otherwise have been a small decline can then get exacerbated to the downside because the dealers need to hedge their portfolios in order to account for the puts that are going into the money. So you get this gamma effect to the downside where we're getting this big drop, and a lot of people are screaming and yelling, "Oh my God, this is a trend change. We're going bearish. There's going to be a recession. Markets are going to be down 30%." But it could be once again a buying opportunity, because if the drop in the markets are happening because of a structural change and not a liquidity change and not a change in valuation or anything like that, then it's a buy the dip and wait for it to go up and to the right. Because the dealers are going to those options will get monetized, volatility will then get supplied again, and there's no reason not to expect up and to the right. And so to me, when I see stuff like this in the markets, I feel like I like knowing, hey, these are the dynamics at play, and I don't have to worry that the sky is falling. I don't have to wake up and the S&P is down 50%.
There's nothing better than observing those types of patterns in the options market for a sense of where we think forward-looking price will go. So, do you feel like this is a stronger indicator than relying on even just implied volatility relative to historical volatility? This gamma observation or gamma squeeze, is that sort of the leading indicator from your perspective?
Yeah, because the implied volatility versus a historical one gives us our premium and discount, like what the options are priced at, but it doesn't let us know what the weakness is within the market. But if the gamma is large enough, then we know that the ground is the environment is set up that if a catalyst did occur, well, then we can have the negative effect, or the opposite. If some good thing happened, we can get the upside. And I like knowing when those periods, when the ground is set for that. And if it's not set for that, well, then I don't worry about it. I don't really care unless something structurally changed with, Nvidia. Like if AI all of a sudden doesn't work anymore and whatever it is, or Elon Musk suddenly died, okay, fine, then maybe I'll short Tesla. But until those things happen, if there's no negative gamma that I have to worry about, then I'm not expecting a big decline. And if a big decline does happen because of those negative gamma, those are buying opportunities.
Understood. I love it.
All right, perfect. So let's I want to touch on the next story here, which is so I just want to. This is something I'm going to really care about for the next 8 years, and that is volatility within inflation, because we're having the situation where inflation has pulled back, right? Or the numbers that have come out have pulled back,
Mhm.
and the big problem with inflation is just that we weren't expecting it, right? So we had 0% interest rates. We had a certain economic regime since the global financial crisis, 2009, and we sort of got used to that. And there were periods of buying and selling volatility and certain blips, Brexit, Volmageddon, whatever, COVID. But then we never had like an inflation scare. We never had to like, oh my God, our food is now 4 times more expensive, and can we go on that vacation trip, and what's my job going to be like, and all that sort of thing. And so the inflation that came out of nowhere introduces volatility, or in other words, uncertainty within our lives.
Mhm.
But I don't know if you're getting the same sense, but there's sort of been like this sense that people are like, okay, well, then there's inflation. Let me just factor that into all my decisions now. When I go to the restaurant, I factor in inflation. When I've given a tip, I factor in inflation. When I'm using Uber, I factor in my inflation, and I just accept that. And so that volatility sort of like ebbs away, even though prices are high. Well, inflation now has started to come down. Core inflation has started to come down.
Mhm.
And the expectation for a lot of people is that we're going to go back to 0% interest rates.
Interesting. Okay.
And I cannot see that happening yet, because when volatility occurs, it's like ripples within the pond. It ripples out, and we have the initial thing, but then it hits the walls of the edges and then comes back. And that comes back is the second round, at least one other round of inflation. So I'm expecting we trough around here, and we get another rise of inflation over the next couple of years. That'll be worse than what we just had, or at least on par with what we just had. And
Right.
only then will I then be going, okay, that might be the aftershock, and now we can be looking towards the deflationary trend that we've been seeing since the dawn of time. But until then, I'm expecting inflation to come back and pick right back up brutally, and to look for trades in that vein over the next 2-3 years, 2, 3, 4, 5 years.
What trades do you think that would be?
Short bonds, short bonds, long inflation sensitive assets. So tips, gold. Depending on what goes on with crypto could be not the highly speculative, altcoins, but Bitcoin, Ethereum, some of the top ones.
Energies.
They could potentially. Well,
energies benefit from inflation quite a bit.
Sure, but I mean, I'm not an expert, but there's so many things happening right now in the energy space. We have this huge demand because of AI, like massive demand for energy. But then there's just these weird things where there's new technologies that have not been deployed yet, but should be able to generate far more energy than what we're used to. Remember, we had the energy scare in COVID, right? And so from then there was all this push. China built coal plants, and nuclear plants plans are in the works in all kinds of different countries. And there's this debate now with in the United States as to should fracking be brought back. Like, there's this demand for energy again, and I'm wondering if I wonder if that takes over and we actually get a deflationary effect in energy where it becomes cheaper and cheaper in order to produce. But literally, I'm regurgitating Twitter spaces that I've seen. I don't have any inside knowledge to it.
Interesting to note, though. Yeah. If we do see a resurgence in inflation, there are definitely some plays there. I think traditionally energy seems to benefit from that. Is obviously increases in price and profitability goes up, but to your point, there could be deflationary effects for sure. I see that.
Well, Kenneth Rogoff talks about here recently this idea of spikes of inflation, and this is why I got excited, because it's a very minority of people who are really talking about the second wave of inflation that we might be getting, a couple of years from now. And this guy's well respected, worked at the IMF, Harvard, Princeton, the whole shebang, has made good predictions. And to see more and more people talk about this sort of idea makes me feel like I'm not out of left field, because I was very annoyed that Nicholas Nassim Taleb, forgive me, I shouldn't speak about him like he's my friend, whatever. Mr. Nicholas Nassim Taleb, when he made bets in that interview that I cite often, that he did in the depths of COVID in 2020, and they're like, what bets are you placing? He's like, oh, I'm betting on inflation. And people are like, what? We've been at 0% interest rate for years. You bet on inflation? Yeah. And then it exploded. I'm like, how did I not see this coming? And so the reason, the last thing I wanted to say about the spike in inflation thing is that we all know you're hearing what Kamala Harris and Donald Trump are talking about for their spending programs. My God, they're going to add trillions of dollars to the deficit, and this whole populist move they're gonna put money into the hands of people in various different ways, and that's gonna fuel this inflationary rise in the United States, which will then export the inflation to the rest of the world, the likes of which we haven't seen for quite a while. That's my fear. That's my expectation. But I'm really curious to get you on the record as to, like, do you think inflation drops precipitously, and that we head towards 0% interest rates, or do you have any expectation that inflation will surge or run rampant?
I think it's too early to tell. I think if we fall into a recessionary period for some time here, even if it's just a technical recession, but if by any factor consumer demand decreases enough, I think that's a deflationary effect on the economy that will be positive from a long-term perspective. However, how it could rebound is if wage growth continues and there's more discretionary spending available, prices are still relatively high, and we see somewhat of an increase in inflation yet again, which is why I kind of don't think that the Fed will ever bring us back down. Well, I shouldn't say the word ever, but in the short term, bring us to 0% interest rates. I think we'll hover right around this 2 to 2.5 range for the Fed funds rate. And it will maybe cut short of inflation, maybe around 1.5 to 2 over the very long run. But I definitely don't think we're going to be in 0% territory. Some of that will be positive, of course, for the stock market as more businesses are able to access lower cost of capital. And as long as the recession lasts a short period of time, I think we kind of stabilize again. But I am no economist. So as far as I can see, which is about one quarter in front of me, maybe not farther than that, I would expect that inflation would remain somewhere down at this level. What would cause it to spike is, I guess, what I'm more curious about than an expert on.
Well, imagine this, Mike. Imagine
okay, hit me with it.
Inflation does rise because of tariffs that or new wars or whatever it is, another supply shock, whatever it is. But because of the dual mandate, the unemployment and the price controls, they decide to abandon the price controls and favor the unemployment. And so what they do is inflation's at 10%, but interest rates are at 0% on short term. So you have 2% and you have bills at 0%, while the 10-year, 20-year is at 10, 15%. That would be unbelievable. I don't even know what would happen. That'd be absolutely crazy because we had a negative yield curve, inverted yield curve for forever. Imagine we had the opposite on the other end for who knows how long that lasts, 4 years.
Especially to that degree, I think that would be more extreme than we've ever seen before, right?
I mean, no one would know what to do, and the volatility you would have.
Yeah,
you would have some sectors that would benefit unbelievably, and then other ones like just tank, and you'd be like, someone would be like, "Oh, I'm up 400% of my portfolio." Someone's like, "I'm down everything." Like I even know what you bet on. I can't even imagine. To me, I sort of want to see something like that happen because it's in these periods of change, in these fourth turning type periods, where we then get to see new things get instituted, and we're out with the old, and new institutions and new habits and new assets get created. So I sort of want that, but then also, it's like one of the aliens to land. Sure, I'd love to fight aliens, but then I have to fight aliens. That's not fun.
Now you got to deal with consequences of that economic environment, right?
Exactly. But they're going to print money. They're going to print money. They said it already. They're going to do it, and the presidents are going to print money. It's election year, so I don't see how that's going to stop. All right. The last thing, as the stories for the week I wanted to touch on is crypto gaining worldwide acceptance. I don't know if you're following this, Mike. I don't know if you're seeing what's going on.
I saw
3 things. Kamala Harris Super PAC has started accepting crypto donations. Now, we already had that with Trump. We already had that with RFK. The leftists now are accepting crypto. Ooh, I love this. Really lends to the idea that crypto is a MI6 or CIA operation designed in order to change the monetary system. But that's fine. That's fine. If I was on Jekyll Island and I was there at the beginning of the Federal Reserve, I would have made money there too. I'm happy to be at Jekyll Island part 2. So you have the Kamala Harris PAC. You have the Russia, because of different sanctions and different issues that they were dealing with, have now quickly legalized or passed legislation to allow for cryptocurrency transactions in their country, especially internationally. Amazing. So crypto being used to circumvent systems within the Eurodollar system. Excellent. Excellent just for the FBI who's listening. I mean, excellent that things are changing and that we're getting access to information, not that these people are doing anything. Third one, Qatar brings crypto rules framework and signs a Web3 development in the Middle East. So major player within the Middle East who are also looking to have crypto as a competing something within their environment. Dude, the Bitcoin people were right. Crypto is starting to bleed into the different nations and actually becoming an option for us to use.
That's right. Yeah, and I think I listened to a podcast recently with Lynn Alden, and she was covering a viewpoint that I hadn't really thought about in a while when it comes to cryptocurrency adoption. I think the case for crypto from a global perspective is more important than ever to really observe. It's easy to look at crypto in the United States as being more of a speculative asset because, for the most part, the vast majority of Americans are speculating on its price and engaging in that speculation through trading. However, there are other countries that are experiencing levels of inflation that would make us feel like it's doom and chaos and the end of America at 40% or 50% inflation rates, and they're going about their day like it's no big difference, right? So the benefit that comes from a deflationary asset like crypto, or specifically Bitcoin, is obvious, is a no-brainer in some of these regions. So the use of crypto across the world as not only a true inflation hedge, but of course to transact in a way that circumvents, or at least frees you economically from governmental control. I get the argument there. That makes a ton of sense.
I never, in my heart, I wanted to be true. I supported Ron Paul for president in 2008, 2012. I'm a quixotic, idealistic former libertarian. I never thought Bitcoin would be adopted in this way at all.
I didn't either. Well, I think initially I did. Like, I first read about Bitcoin in Wired magazine in 2012, and I was like, this is amazing. This is a libertarian dream. This is the best way to get away from the Fed's ability to just keep printing money over and over and over again. The invisible hand is dead. Like, we've got this ability to have an asset that we can truly control. And I remember even buying things with crypto, or Bitcoin specifically, back in 2013 or 2014. I think Overstock was one of the first retailers to provide Bitcoin as a payment option. And I bought my wife a pair of high heels and a dress that we were going to wear to a party. And those are the most expensive items I've ever purchased in my life. I think today those high heels and dress are probably worth, I don't know, a couple $100,000.
Oh my God.
So it's it occurred to me very early on that this was not something you could transact with, at least initially. Right. If we get closer to a stable price in cryptocurrency and it becomes widely adopted as a payment form across the map globally, then I think we get something closer to a global currency, which is quite interesting to me, especially like in situations like for TradersPost, where there are other countries we can address as customers, but we're kind of walled off from transacting, not only because of the currency exchange problem, but a price parity problem, right? Where we can't really offer these services in a way that's addressable or affordable for people on a relative basis to US dollars. So it would be interesting to see how cryptocurrency can start to unfold to create global commerce as well.
Right. Well, I guess I should have seen it more, because I think about 75% of my transactions with clients are in crypto. I just never really think about it because I see USDT.
Yeah, but you sell it back into US dollars right away.
Of course, because US dollars is worth way more than crypto to me.
I think the same is true.
I get paid in stable coin.
Say again.
I get paid in stable coin, so to me it's always a US dollar anyway. I'm not buying the crypto.
Oh, right. Okay, fair enough. And so even if the super PAC is actually accepting crypto in Bitcoin or Ethereum, I'm not sure what cryptos they're accepting. I'm sure they're selling back into US dollars right away.
Immediately, they're using the Coinbase, sort of like the PayPal for crypto, and so as soon as the transaction happens, they're only getting dollars. But I just love the idea of it because it was so poo-pooed, 5 years ago, 7 years ago, and now it's like, oh no, of course we, they're going to bend the knee at the Bitcoin conferences. I was like, okay, that's pretty interesting. So that'll bring us to our last thing here that
Okay.
I want to touch on, which is Bitcoin and your price predictions or your analysis for the Bitcoin chart. To me, has been invaluable. It helps really with my own thinking. I do want to lead with one thing
Sure.
because I'm extremely annoyed with myself. Um, and that is I go through all this trouble to build indicators for myself that tell me what the liquidity conditions are, and then
And
for
then you don't
some
use them.
reason I don't freaking use them. My signal over here was saying, let me just pull it up on the screen here real quick. All right, I know it's a little crazy here, but I had a signal over here. Actually, let's look at the SPY here. It'll be more clear. So here I have a signal that says, "Hey, we have a this red triangle means a pullback in liquidity," and I don't know why I don't listen to these things. This day where I got this, I'm looking at the options for the SPY at this level, and I talk myself out of buying them. I bought sushi that cost as much as the options for the SPY, and I could have bought them and made a bundle. It drives me crazy. Do you find yourself like not listening to your own analysis?
100%. It happened with Nvidia in its first pullback. I had pegged the retrace somewhere about around $90, right above the 200-day moving average, and I think the low that day was $90.69. And I missed that. I missed that bottom wick opportunity for sure. And it happens all the time, especially as traders. I think it even happens in automated strategies where your strategy is waiting for one more indicator or one more confirmation, and you just miss that little window. But there's always the next one.
Well, this yes, you're right. There is always the next one. All right, so for me, just a quick look over here. What I'm looking at for Bitcoin, actually, this is not the best chart for that. Let me pull it up. I am looking for all right, so I'm looking for price to get back to get down to here to the 50K level or around the 50K level. But anywhere around here is where I'd be thinking for a first low in like if there's going to be a bottom at all, it could be around this area here. Especially since for the dollar, so we got that bounce. I know we talked about this last week. We got that bounce in the dollar at the 100 level.
Yep.
We've bounced again, but it's always about the lower high, right? So the lower high over here didn't break up to this level, which is what I was sort of my doomsday scenario, like short-term doomsday scenarios that we get back up to 102. We didn't. So my question is if this bounce is the bounce that leads us there, if this is the high or low. But even if it is, it does to me suggest that we're going to be moving sideways through this area before we then eventually break down below 100, which is then bullish for crypto and for assets. What are you thinking as far as price for Bitcoin?
I think that might coincide with the next potential bounce. I think we are going to pull back a little bit further on Bitcoin. If I could share my technical analysis on this.
Yeah, let me pull it up.
So the chart that we keep referring to is the one I've had open for 9 months now. So the main range that I've been paying attention to is that first retracement back in January of 2024. And I've been watching this pullback the entire time. We touched or literally wicked the 0618 retracement on Bitcoin. And since then, I thought we might be headed for positive territory. But this little range of pricing here shows me that we did not hit a new higher high, which is kind of what I was hoping for. But even if we had touched the 70,000 higher high, we still need to get past this trend line in order to really confirm that we're going to be moving into a new range. So this pullback again is, I think could have been fairly well expected once we broke below the 8 EMA on the short-term basis. Once we printed this reversal right here. So for several days since then, I think it's been a fairly obvious trend. From here, however, I'm not entirely sure where support shows up. I'd like to say we come back here and retest the 49.3 level, because that would, sort of give us some confirmation that the 0618 retracement is the pullback level traders are hoping for people to start accumulating from here. But I'm afraid to say that we probably pull back even further than that to hit the long-term trend line. And that pushes us closer to 44.2, somewhere around there. So I'd like to see how we respond to this overall trend line right here.
Yeah, it's that wick from the what was that? August 5th. That wick down. So wicks tell the story.
Sure.
And so the fact that we're revisiting right now, if the next candles right now, we don't get strong, significant wicks like we saw then it means we're, I think Linda Raschke calls it eating the tail in a sense, and that we are chewing through that support, but to the downside. And if that breaks, well, then I also have like 40K as the low end as to where I'd expect the next support to be. Because there's not a bunch of support in these areas. The Peter was asking, like, what is the what's causing Bitcoin to sell off? My flippant answer is always it's liquidity. Liquidity is pulling back. Like global dollar liquidity is pulling back, and we're seeing that, show up in all kinds of different assets.
I was going to refer to the global liquidity index here, because we've actually been rising pretty steadily since even that last wick on Bitcoin. But generally through this whole downward accumulation phase, it's been slowly marching upward. And we're well past that resistance zone we were previously monitoring around 91.5 on the index. And we're now at a point where, we're at 93.7. So as we march higher and higher, the availability of capital seems to be growing, which I think is a good case for the idea that there's plenty of cash on the sidelines ready to test that support level and hopefully can confirm a reversal from here. Maybe one other indication I would probably point out is that the correlation of crypto to the S&P 500 is growing over these last several weeks here. If we just look at the correlation over a rolling 20-day period, we had reached almost 90% correlation at the beginning of August, kind of pulled back a little bit. It seemed like it was acting a little differently as we retraced in the S&P 500. But now as markets start pulling back again, that correlation is rising again. We're at 70% correlation now.
So I think this is one of the mistakes I made for myself. We'll see long term if what that does. But I was also looking at liquidity the way you're doing over there, but I forgot to take a look at my other. So in addition to my liquidity indicator that you're right shows an increase in M2 money supply, I have a gauge down here that detects basically credit issuance and for commercial institutions, and that when I get higher highs on there, it means that there's a tightness within the credit issuance. And so liquidity is only bullish if it actually gets to places, right? So why do we see inflation explode? It's because the money that was being printed was staying within the financial markets. So asset price inflation occurred and housing price inflation occurred because that's where the dollars were touching, but it wasn't touching, your cell phone. It wasn't touching the food at the grocery store and that sort of thing. And it's when the liquidity poured out and started touching those areas, well, that's where you get that inflation. I tell my kids all the time, if you print $1 billion and keep it in your basement, nothing happens to the prices around you. You start spending that money in your neighborhood and giving it to people, well, prices are going to rise. Mm-hmm. And so here the liquidity was there, but it wasn't actually getting into financial assets and into crypto, which is why we had this sort of resistance. Like we have over here. Actually, let me show it to you on this way for NFCI. So this is one of the financial conditions index from the Fed, and we had this wobble up. I know it's small, but it is a higher high very tiny, but it is a higher high over here. Two of them happened. So we had it over here and then over here again, and which is just showing this volatility, minor volatility within the financial the credit space. And if you take a look at other assets as well, like if you take a look at what's going on with China, with Japan, with some of the European countries, there is wobbling happening within the credit space. It's not down. It's not like terrible, but it is a wobble. And if we get a bottom within that at all, well, then it's like VIX at 12. We could get these spikes in credit issuance, or like lack of credit issuance. So when I see Bitcoin pulling back as liquidity is going up, then I know, for me, that tells me the liquidity is not getting to the assets I expect it to get to, especially with gold up. Gold hasn't fallen, right? So we know it's not a structural thing, or solely a structural thing. If gold is still up, that means there's still a bet against the central banks and the health of the financial systems. And so it makes sense that we would see that in Bitcoin as a pullback in that speculative asset, whereas another safe haven asset like the Swiss franc or gold would stay up. So
Copy
we'll
that.
see.
Yeah. Well, I think in general, I tend to be more technically focused. So at least for crypto, the best indicator I have is where price starts to support, where price shows up on support and resistance. So I want to see where support is as we continue to retrace here. And then I'll be waiting for confirmation above some short-term moving average to see a continuation from there. And then, as usual, we want to see higher highs and higher lows before we really know where we're going.
So that's what I was going to ask. So even if it hits, let's say it hit 40,000, you're not a bottom picker.
Yeah, it's hard to catch price on its way down unless you're truly confident from a fundamentals perspective. Like I'm trying to catch Nvidia on the way down right now, but I understand the fundamentals of Nvidia. It's harder to understand the fundamentals of crypto and the speculative effect that takes place in traders' minds here. There's not something I can relate to from a fundamental perspective that's going to show up in, like in Nvidia's case, as I'm catching that falling knife. I know that the fundamentals I'm looking at now aren't going to show up for another 2-3 months before price starts to pull back, retrace again and head to the upside. For crypto, there's nothing for me to really rely on except for how traders react to market conditions, global conditions, and overall price action. So I'm more hesitant to jump in as it's making its way down.
Fair enough. Okay, that makes total sense. All right. Well, that's it for us for this week. Always fun to talk to you, Mike. I feel like I save I don't even bother talking to other people about it. My chat groups are like, Tom, you've disappeared. It's like, no, it's Fridays with Mike. That's what I'm saving all my conversation for.
I feel so special now.
All right, so we'll leave it there. We'll be back next week for after hours. Again at 3:30 for office hours, and then after hours we'll start at 4. We'll go over the news of the week. Thank you very much and have a great week.
Great. And as always, everyone, please like and subscribe. Any comments you guys can provide on these subjects are always helpful. Happy to respond to anything you have in terms of feedback or ideas around some of the discussions we've had here today.
Cue the exit music.